Hey everyone, welcome back to Corporate Decoder, the place where let's just say some companies are having a bit of a rough time staying on the big stage. Get ready to decode a report that's all about facing some serious questions about a company's very existence. Before we dive in, if you dig getting straight to the point with corporate filings, make sure you are subscribed. And hey, we have a great Discord community linked in the description below where we talk about these filings and more. Today we're looking at a filing from Synlogic Incorporated, a company that is finding itself in a bit of a bind. This isn't your typical quarterly earnings report though. This is a Form 8K, which usually means something kind of urgent has happened. And in this case, it's about continued listing on the Nasdaq stock exchange. Nasdaq is that big stock market where lots of tech and growth companies trade their shares. Think of it as the VIP club for public companies. So what's the big issue here? Nasdaq sent Synlogic a letter basically saying, hey, we think you are a public shell and your stock probably shouldn't be listed anymore. A public shell company in simple terms is a company that doesn't have much going on in terms of actual business operations. It is sort of like a company that exists mainly to be publicly traded. But without a real product or revenue, Nasdaq is pretty strict about this. They want to see real business activity. The reason Nasdaq is concerned, and they spell it out pretty clearly, is based on Synlogic's own public disclosures. They looked at what Synlogic has been saying in its recent quarterly reports, the Forms 10Q, and saw some troubling signs. They noticed the company has no revenue generating assets and that employee numbers and operations have shrunk dramatically since February of 2024. That's a huge red flag for a stock exchange. You can't just exist on paper and expect to stay listed. Let's drill down into those numbers. The filing points out that for the first 9 months of 2025, Synlogic reported absolutely zero revenue. That is right. No money coming in from selling anything. On top of that, they're spending on research and development, which is usually where companies invest to create future products, was a minuscule $16,000. To put that into perspective, that is less than many people spend on a car in a year. When a company shows no revenue and such tiny R&D spending, it really makes you wonder what they're actually doing as a business. Now, Nasdaq isn't just kicking them out immediately. They've given Synlogic a chance to fight back. The company can request a hearing with a panel. If they don't ask for this hearing, they'll be suspended from trading and eventually delisted. Think of this hearing as their last chance to convince the Nasdaq that they are a legitimate, operating business worth keeping on the exchange. Synlogic, however, doesn't agree with Nasdaq's assessment. They believe they are not a public shell and plan to ask for that hearing. Their strategy here is to get a hearing which automatically stops any delisting action until the panel makes a decision. They're hoping they can convince the panel they have a future worth investing in. But, and this is a big but, the filing honestly admits there's no guarantee they will win this hearing or be able to meet all the listing rules, even if they do. So even with the appeal, the future remains very uncertain for Synlogic's continued listing. Now, like most corporate filings, this report includes something called forward-looking statements. This is just a legal way of saying they are making statements about what they expect to happen in the future. They use words like will likely result or expect to signal these are predictions, not facts. They are basically trying to protect themselves from lawsuits if things don't turn out as planned. They clearly state that actual results could be very different from these future expectations. And importantly, the company is being very upfront that they don't plan to update these predictions unless the law requires them to. So you should take anything about the future with a grain of salt. So let's put on our Warren Buffett hats for a moment and look at Synlogic. What are we seeing here? The core issue is the lack of any revenue. A business that isn't generating revenue is fundamentally struggling. Nasdaq's concern about it being a public shell makes perfect sense when you see zero revenue and very minimal R&D spending. Even if they are developing something, the market represented by Nasdaq's listing standards isn't seeing enough viable progress. The risk here is pretty straightforward, continued delisting from Nasdaq, which would make it much harder for investors to buy or sell their shares, and generally signals a very weak financial position. The opportunity, though slim at this point, lies entirely in their ability to convince the Nasdaq hearings panel that they have a credible plan and a viable business moving forward. Without a strong business case, surviving as a publicly traded company on a major exchange is incredibly difficult. What is your take on Synlogic's situation and their chances at the Nasdaq hearing? Do you think they can turn things around? Let me know your thoughts in the comments below. If you found this deep dive into their 8K filing helpful, please give this video a thumbs up. It really supports the channel. And don't forget to subscribe for more corporate breakdowns. And remember to check out the Discord link in the description to join the conversation. Thanks for watching, and we'll see you in the next one.